The first carton of milk might seem like a bargain, but once that deal ends, prices can rocket by 275% to 300%. Mexico has gone full throttle to expand its dairy industry. Meanwhile, U.S. officials complain loudly about Canada's so-called protectionist dairy rules. Yet, in a twist of trade irony, Canada has just secured $3.2 billion in Mexico's dairy business without so much as a press conference or public handshake, replacing American suppliers almost silently. This shift didn't happen in a blaze of headlines. It unfolded quietly as Mexico, once one of the biggest buyers of U.S. milk, closed the valve on imports from Wisconsin, Ohio, and other dairy strongholds. Into that gap stepped Canada, offering cleaner supply lines, stricter quality controls, and something Washington appears to be losing: trust. For U.S. farmers already battling tariffs, drought, and soaring input costs, the loss isn't just disappointing, it's a gut punch. Why would Mexico, America's closest neighbor and trade partner, cut off U.S. milk? Why now? And why choose Canada? Could this be a short-term shuffle? Or is it the start of a lasting change in who feeds North America's largest cities? The bigger question: is this how a superpower loses its seat at the agricultural table without realizing it's gone? American dairy used to dominate. In 2023, Mexico alone bought $2.32 billion worth of U.S. dairy products, nearly a quarter of all American dairy exports. But on February 4th, 2025, President Trump imposed a 25% tariff on Mexican imports under emergency powers, shaking decades of trade stability. By the first quarter of 2025, dairy export values had slipped 0.5% from the year before, signaling a slowdown. Cheese shipments to Mexico dropped 5% in volume, marking the first quarterly decline for any major U.S. dairy item in years. Over 2024, Canadian producers quietly expanded in Mexico. Shipments climbed from $2.86 million to $4.78 million, a 67% jump year over year. While still small compared to America's billions, that surge proves how quickly markets can pivot when one supplier stumbles. Mexico's policy now favors partners with airtight supply chains and strong domestic backing. Washington can no longer assume loyalty from its largest dairy customer. Rising costs at home make matters worse for U.S. producers. Without strategic fixes, from diversifying markets to renegotiating trade terms, America risks ceding more ground to competitors who are better aligned with buyer priorities. The dairy clock is ticking, and the once undisputed U.S. advantage is no longer secure. Canada's success isn't accidental. On January 10, 2025, Ottawa implemented a national dairy code banning growth hormones and routine antibiotics while mandating plant-based rations for all export herds. By mid-April, Canada's Pro-Action traceability system, integrated with Dairy Trace and Simply Trace, allowed every liter of milk to be traced back to its farm of origin. That transparency reassures buyers. By May 2, 2025, the U.S. was still using lot-based tracking, with roughly 80% of added ingredients lacking digital capture, a gap that weakens accountability. In late June, Mexico refused a U.S. milk shipment for failing to meet Canada's ethical benchmark. That single rejection cost millions and sent a blunt message: high volume no longer guarantees a sale. Global buyers now demand proof of humane treatment and complete traceability. Without matching Canada's standard, the U.S. risks more losses. This is part of a wider transformation in food trade. Transparency and ethics aren't optional, they're required. The stakes are huge. In early 2025, U.S. dairy exports dropped by 0.7 billion pounds in just 3 months. Mexico's decision to walk away from one of America's most consistent exports shows how ethics can reshape markets. Younger shoppers, in particular, are willing to pay more for fully transparent products, knowing what cows eat, where they live, and how they're treated. Canada answers with honest labels and track-to-farm verification. For U.S. farmers, the fallout is brutal. By mid-2023, the number of licensed dairy farms had fallen to just 26,290, the lowest in modern history. Rising feed, labor, and equipment costs have squeezed margins to the breaking point. Volatile milk prices, trade disputes, and unpredictable weather have pushed many family farms over the edge. In Canada, small dairy farms remain stable thanks to production quotas and price insurance programs. Those protections keep barns full and communities alive. North of the border, investors see steady returns. South of it, they see risk and debt. Mexico's importers notice this reliability gap and increasingly turn to Canada. If Washington doesn't act, the crisis will deepen. Rural communities that depend on dairy revenue could face collapse. For small-scale farmers, this isn't just about lost income. It's about losing a way of life. When President Trump's tariffs hit in early 2025, Mexico's trust in U.S. supply chains began to erode. Canada, meanwhile, doubled down on transparency, ethical production, and verifiable quality. That combination has made Canadian milk the safer bet. Trust now carries its own market premium. American dairy leaders face a choice: overhaul systems to match Canada's farm-level transparency, or cling to old habits and watch market share fade. The Mexico-Canada dairy deal isn't just another contract, it's a warning. Volume can't compete with verified ethics. So the real question is, what story will the U.S. tell behind every gallon it exports? In today's dairy wars, trust wins. And Traveling Vibes will keep watching to see who earns it.